What's going on, guys? It's Vic, and today we got the CPI data that came out on inflation, and of course, we are at greater than 40-year highs, basically only competing with the 80s and 70s for inflation. So it's almost double digits, and it's getting more crazy every single time this data comes out. So it's not great. Markets not reacting too well to it. Originally fell a lot. Bitcoin had a big move down, but then everything kind of recovered. Now things are falling again. So no one knows what's going on. And we now have the talks of the 100 basis point or 1% hike coming in the next meeting instead of the predicted 75 basis point hike. So a lot of things going on, but the Fed probably doesn't even know what they're doing yet. So we'll see how it all plays out. We'll probably expect a 1% hike, but this is the inflation data right here, 9.1% for year over year, which is ridiculous, almost double digits on CPI, which, keep in mind, is designed to stay low. It is not, it's way lower than real inflation. I think everybody knows that. I don't think anyone looks at CPI and says, yeah, that's right. I think everybody can kind of agree inflation's higher than what CPI says. But even CPI getting to almost double digits, and then the 1.3% month over month, it's like one of the highest readings of the last couple decades, which is insanely ridiculous. We can see right here, this is the month over month rating or increases here. We see the latest one, 1.3%. You'd have to go back to 2005 at 1.4% to get a higher month over month reading than what we just got. So honestly, ridiculous. And if you look back this year, we have a 1% and a 1.2%. It's just multiple greater than 1%, which annualized would be like 12, 13, 14%. So inflation is just continuing to get worse and worse. And it's just seems like it might be about time that the Fed really hunkers down and decides we're not going to get a soft landing that they want, and they have to go all out after inflation. This month's inflation could be the turning point, though, maybe, because we can see like this oil prices. We know oil started falling around the middle of June, so oil prices started falling. Gas prices started going down a bit, so gas and energy is the biggest sector here of inflation. You see 41.6% for energy, which is insane. But it might be, oil price coming down, gas price coming down might bring the inflation reading down for next month. Who really knows? But we did have something like this kind of play out already. You can see in this chart where we had this original we thought was the peak, and it moved down quite a bit, at least for month over month, and then skyrocket right back to almost all-time highs for the last 15, 16, 17 years. So nobody knows exactly what to expect. If we look at year over year, it's still not much better. We can see the chart, basically a direct line up, and only higher is the 70s and the 80s. So we're competing with literally all-time high inflation, more than 40-year high inflation. Every single time the reading comes out, it's always 40-year high inflation. And we can look at the R word, which is recession, coming out. A lot of people researching recession, a lot of talks about it. This is just Google Trends, so kind of like the public's display. I know articles, it's like moving up a lot in articles talking about a recession, in earnings calls talking about inflation and recession. But right now we can see this massive spike up higher than just before the 2020 crash and the short recession we had there. I'm not sure what really happened in 2019 here to make people worried about a recession, but we see these spikes, and we got a recession after this spike, and now we see another spike, and it's coming down. But we got the recession a little bit around this spike here, so we might be already in the recession, which technically I think we already are. We're going to have a second quarter that's negative, and that's a paper recession. But we basically have the worst situation we could ever ask for is stagflation, where we have high inflation and stagnation of the economy. And when you combine those two, it gets way harder to just buy, the necessities you need to live, and things start to get really bad really quick. So we don't want this situation. but we're in it. And these charts show a ridiculous story with personal savings rate. We see these are the stimulus packages that were passed when these spikes were, and it's already plummeted. So if you look to where it's plummeted 5.4, and before we were around 7.5 for the like normal range before 2020, and we'd have to go back to around 2008 to get these levels similar. So these were lower levels before like 2006 and stuff. But during this recession, 2008, 2007, 2009 is when these were around these levels. We're actually a little bit lower. We're around the bottom levels here. But that recession had the same saving rate. So, we don't necessarily want to get back into a 2008 situation. That wasn't fun for anyone. But it looks like we could be heading there. And on top of that, we have consumer debt, which are consumer loans, credit card debt and revolving plans, commercial banks, is just up and to the right. So we see this peak here at like 858, call it 860, move down on stimulus packages and, cheap money coming in. So people paid off debts. And then it went right back up, 883, higher than where it was before it started going down. And that's a problem because you combine this, the problem here where you have people getting more debt just to try and get by and pay for things, combined with lower savings, and you have like a debt bubble forming where people are surviving on debt. Eventually people's credit lines they're going to be maxed out, and they're not going to have the savings to pay it off. So you're going to have all this debt that could collapse and be defaulted on. And then you have massive implications from that for financial markets and banks and everything. So it's just a lot of things shaping up to not being put in the best place. We have high debt, low savings. It's not a good combination. And we can see markets like the S&P kind of mixed on this news. It had a big drop down to like 374 here, but ultimately kind of went up, moved up. It's still red on the day, down 0.5% for the S&P, but a little bit of a mixed bag here. We have, these different things here, green for some stocks, red for others, and it's kind of mixed all around the place. Bitcoin had a bigger reaction to this than maybe people thought. Maybe we can see it here. Yeah, this was release of the data around this time, and big move down. You had people saying, oh my God, Bitcoin's an inflation hedge, ha ha ha. And then, it moved back up and no one said anything. But these like short-term moves in anything, in all these stocks, every asset is going to happen because of this news. Everyone is eyeing the Fed and deciding what's going on. Like, are we going to hike rates aggressively, and that's going to scare people out of markets? If the Fed gets more dovish, then that's going to push people into markets. So short term, you can't tell which way things are going, because if you would have bought on the CPI data being low, you would have been wrong. And if you would have sold on the CPI data being high, you still could have been wrong. So it's more of a time where if we are in a recession already, which could be evident of these prior spikes, where when it spiked, we went into recession 2020, even though it was short and the Fed U-turned very quickly, it was still a recession. And now we have another spike, even higher than the last one. But if we are in recession right now, we would have already been in it for a little bit of time. It would have officially started on July 1st for a paper recession, but we could have already been in a recession for a few months now, maybe 6 months. And at that point, you don't have much more time of the recession to actually affect markets. And right now could be the best time to be buying assets. When we see things plummeting because of recession fears and people scared that things could happen, then you could be buying when there's max fear. And then when things go back to normal, or the Fed pivots like they're going to have to do at some point, then assets skyrocket. And this is where like millionaires are made in recessions. And the Fed did learn that even though recessions, obviously no one wants them or something, they could tighten very fast and just kind of fight inflation and kill demand. And it would probably be painful for at least a short period of time. But they did learn from looking at like what they did in 2020 with the COVID stuff, that this massive drawdown, that they could reverse very quickly and have it really, really pump up. So they know they can reverse quickly. They know that they've already done it before. So maybe that's in their tool belt to just really go after inflation, hike rates to the moon, and assets could crash, but then they can U-turn very quickly and send everything, skyrocketing back up and make the economy start going again. Does it work? Is it going to work again? How many times can you actually do it? Still pretty good questions to ask. But the CPI data, obviously not good. 9.1%. We wanted, I think it was 8.6 or lower to be able to have green day in the market. We ended up getting a mixed day on even higher inflation. So just crazy that we're talking about almost double-digit inflation and stagflation in 2022 in the US. That's gonna do it for this video, guys. As always, don't forget to smash the like button and subscribe on the road to 1,000 subscribers. And I'll see you guys in my next video.